So in this question, Warrburt Group cash flow statement, what I have done is I've set up a pro forma statement of cash flows, operating, investing and financing cash flows. Add those three up, it comes to the movement in cash and cash equivalents, and that should tie into your opening and closing balances. The one thing that you do not do in the exam is you do not add up your group cash flow statement. You just assume that it adds up because there's no marks for actually adding it up in the real exam. So what I've done, I've cross-referenced the additional information to the individual elements of the statement of financial position and income statement. And what I'm actually going to do here, I normally do things line by line, but personal preference is I always like to start with the income statement. It's just the way I am, just the way I'm wired. So I'm going to do that, and I'm going to go to my income statement, and the first thing I'm going to do is to look for my profit before tax figure, except here it's a loss before tax. And that loss before tax is 47 million. And what I'm then going to do is I'm going to look for items which are either not operating in nature or not cash flow in nature, which are above the profit before tax line. So looking at that, well, we've got a share of profit of associate. So my share of associate, and the key here is to do the opposite to what you do in the income statement. In the income statement you add in the profit of the associate, so we're going to subtract it. And at the same time I'm going to open up some T accounts, the first of which is going to be for associates. And let's remember our double entry principles. Associate income, well, income is a credit in the income statement, so it must be a debit in the T account. Income statement, profit share is 6. We've got finance costs. Now, finance costs are a deduction in the income statement, so what I'm going to do here is I'm going to add them back. Now, I've referenced finance costs to note 6. It looks like some adjustments are required. So rather than take away the cash flow for finance costs, I suspect we're going to need a T account, and it's debit the income statement with the expense, so therefore credit the T account with the finance cost expense of 9. Admin, distribution, other income, I'm not quite sure what other income is. I'm going to leave that for the moment. Then I'm going to move, so having moved my way, starting with my profit before tax, I go up to identify non-cash flows and non-operating items, and I'm now going to go down, and the first thing that we see is tax. We know from historical experience the T account is probably going to be needed. It's an expense, debit the income statement, credit the T account with 29. That gives us a loss for the year. We've then got some bits and pieces, but they're nothing to do with profits as such, so I'm going to put little OS's by the side. OS simply means outstanding. I'll come back to that later. We've got something in respect of OCE. Sorry, it's in respect of non-controlling interest, but I've had a quick look. I've got a statement of changes in equity. If I have a statement of changes in equity, I use that for all of the equity items. So I'm going to leave the rest of that statement of profit and loss. And now I'm going to turn my attention to the statement of financial position. The first thing I've seen is PPE, but I've also spotted in note 3 that note 3 is the equivalent of a T account for PPE, so I'm not going to bother there. Next, we've got goodwill. open up a T account. Not quite sure what's happening with goodwill. And my advice to you is, if you're not sure, open up a T account. We have an opening balance of 100 and a closing balance of 80. We have some other intangibles. What's happening with these intangibles? Well, I'm not really sure. So I'm going to have working number 5 for intangibles. Opening balance 240, closing balance 228. Sometimes you'll find that you don't need these T accounts, but I'd say it's better to be safe than sorry. Investment in associate, we don't have a balance at the start of the year. So our balance brought down is somewhat strangely 0. Our balance to carry down is 100. And investments, I've referenced investments to note 1. Note 1's quite comprehensive, so I'm going to leave that until we get to note 1. Then we've got our current assets. So what I'm going to do is that I normally set out my cash flow statement half a page for operating cash flows, a quarter of a page for investing and financing. That just comes from experience. And what we tend to do is that we tend to group our working capital items together. So I'm going to leave some space. You don't have to do this. You won't lose any marks, but movements in working capital. And what have we got here? Well, we don't seem to have acquired a subsidiary in the year, so nothing to worry about in that score. But as far as inventories are concerned, inventories have gone down. Asset down equals cash up. So I'm going to show that movement as an increase of 63. Next we have receivables. Receivables have gone down. Asset down equals cash up. That's a movement in 71. And next we've got cash and cash equivalents themselves. A quick check, do we have an overdraft? No, we do not. So I've got my opening and closing balances. My opening balance is 323. My closing balance is 288. Therefore, cash and cash equivalents have decreased by 35 in the year. In theory, if we add it up correctly, it should add up to minus 35. I'm not going to do that in the exam though. I'm just going to assume that it adds up. Be confident. It's a good trait to have. Next, we've got share capital. A quick note, or quick look at the notes. There's no references to any changes in share capital, but what I'm going to do is I'm going to deal with all of equity in the statement of changes in equity. So I'm going to leave all of my equity items and I'm going to turn my attention to borrowings, sorry, to liabilities. And the first thing that I see in liabilities is long-term borrowings, and they've gone down, so therefore they must have been repaid. Liability down equals cash down. We've got deferred tax. Not quite sure what's happening with deferred tax, but ultimately it's a tax balance. So an opening balance of 24 and a closing balance, an opening balance of 26 and a closing balance of 28. So all I'm doing is I'm just slotting in numbers from the question. Next we've got long-term provisions. I've referenced that to the pensions note. So I'm going to deal with that when I get to the pensions note, because I think the pensions note is going to solve everything for me. That's note 2. Next we've got trade payables. I've referenced trade payables to one of the other notes, so I'm not going to put in quite a finished answer here. So what's happened to payables? Payables have increased. Sorry, they've decreased. They've decreased by 65. So therefore, I'm going to put that in as my movement of 65. We've got current tax payable, 42 and 35. So current tax, opening balance 42, closing balance, current tax 35. Next we've got short-term provisions. I've referenced this to note 6, and it says in note 6 they relate to finance costs. So we've got an opening balance for finance costs of 4 and a closing balance for finance costs for 5. So I've dealt with all of the income statement and all of the statement of financial position, apart from those items where I'm going to use the notes to solve the problems. So having dealt with the income statement and statement of financial position, I'm now going to take a look at the extra information. This is a huge question, and we've got our statement of changes in equity. And the first thing we see, share capital, we've issued some shares. We've issued 55 worth of shares. So I go to our financing cash flows, shares issued, equity up equals cash up. Retained earnings, we've got our profits for the year, our opening and closing balances, but more importantly, we've got dividends. Well, dividends are part of financing. Dividends paid. If it's paid, it's cash going out of the business, so I'm going to show that figure of 9 going out. IEI, that's investment in equity instruments. Not quite sure what's happening there. We've got a revaluation in the year, but that's linked to PPE, so we'll sort that out when we get to our PPE. And then we've got the non-controlling interest, and the important thing to pick up from the non-controlling interest is that in terms of cash, we have paid a divvy to the NCI in the year, and that dividend is 5. So I'm using the information in the question all the time to generate marks. Sorry? Yeah, that's fine. If you put 14, that'll be perfectly acceptable. Though you're better off showing them separate. We then come to the additional information, and the first thing is that we've got some information about our investments, note 1. And we've got bits and pieces in relation to the pension. We'll come back to those later. At the start of the year, the total amount of the investment was 150 million, some of which we're going to deal with through movements in OCI. The remaining 38 million relates to an investment in Warrburt, in respect of whom changes in fair value are taken to profit and loss. During the year, the investment in Warrburt was sold for 45. I see the word sold, and a little alarm bell goes on in my head. That's cash, isn't it? When you sell something, so sale of investments. If you sell something, that's cash coming into the business. So we've sold them for 48. They had a book value, sorry, they sold them for 45. They had a book value of 38, with the fair value gain is shown in other income. Well, this is not a cash flow. The gain is not a cash flow. So just like the gain on disposal of the assets, gain on sale of investment, 45 less 38, That's not a cash flow, but that gain has gone to the income statement. If it's a gain in the income statement, it's a positive. We're reconciling in the cash flow, we show that as a negative. So as for all the rest of it, well, it's just pretty dull. I mean, the only thing of any interest to us is we've got deferred tax of 3 million arising on the 30 million revaluation gain has been taken to OCI. So when we go to our tax computation, OCI, we've got a deferred tax gain there of 3 million. Note 2 is our pension. Our expense for the period is the service cost plus the interest cost. Is that a cash flow? The answer is no. So what I'm going to do here is I'm going to go up to my cash flow statement, pension, income statement, expense. I'm going to add that back because it is not a cash flow. What is the cash flow? The cash flow is the contributions paid into the scheme. It's a little bit strange here that it's identical. But what we normally do is that because it's not relating to day-to-day activities, you normally show your pension contributions at the bottom of the operating section of your cash flow statement. It's not essential to do it there, but it is convention. So that deals with note 3. Warrburt recognises gains and losses in OCI, so that's not a problem because it doesn't impact upon profits in accordance with IAS 19, that's fine. The benefits paid by the trustees were 3 million. That's cash which has been paid by the pension fund. It's not cash which has been paid by us. So we don't have to worry about it. That's the examiner being a bit sneaky. There's no tax impact to worry about. Note 3 is PPE. And it says in note 3 that we've got the carrying value, which includes additions of 78. So I'm going to go to my income statement and say purchase of PPE. It's 78, but I've referenced this to one of the other notes, so I'm going to come back to that a little bit later. We've got a revaluation gain, nothing to do with cash flow. We've got a disposal. Now, what I'm going to do here is I'm going to open up a disposals T account, because I'm not quite sure what's happening. And the value of the disposals is 56. So that's their carrying amount. And then the final item in our PPE note on the bottom of this page is depreciation. What do we do with depreciation? It's a non-cash expense, so add it back to profit. Depreciation, I'm going to add back 36. At the top of the next page it says plant and machinery with a carrying value of 1 million was destroyed in the fire. The asset was replaced with new plant and machinery valued at 3 million. They were required directly by the insurance company and no cash payment made by Warrburt, so it doesn't have impact upon us. But the net gain on the transaction in additions as cost has been shown as a deduction from admin expenses. Well, that is a non-cash deduction. So what I'm going to do here is to say that we've got the gain on the destroyed plant. That's a gain in the income statement. It's a non-cash gain, so I'm going to deduct it in my cash flow statement. We're told that the disposal proceeds were 63 million. So we go to our investing cash flows, sale of PPE is 63 million. That's in relation to our disposal, so I'm also going to put it into my disposal account. Debit cash, credit disposal account, 63 is our cash flow. The gain on disposal is included in admin expenses. Well, we can quickly calculate that. We've got a gain on sale, or gain on disposal, is the balancing figure of 7, and that's been included in admin expenses. It's a non-cash figure, therefore we have to take it away in our cash flow statement. Gain on PPE disposal. So a lot of these items are carrying over from F7. The remaining additions of PPE comprise imported plant and equipment from an overseas supplier. This is looking a little bit complicated, so I'm going to open up a new note in respect of currencies. And let's work out what's happened here. Oh, sorry, yes, I've missed off. Deferred tax of 2 million has been deducted in arriving at the gains on the property revaluation. So what I'm going to do is I'm going to put that into my deferred tax calculation here. Revaluation, deferred tax, 2 million. Sorry, I've missed that figure off. The remaining additions of PPE comprise imported plant and equipment from an overseas supplier. The cost of the PPE was 380 million dinars. So the cost, what was the date of purchase? The 30th of June X8, 380 million dinars, and at that date there were 5 dinars to the dollar, so that works out as $76 million. Debit PPE, credit payable. We're then told that we paid 280 million dinars. So the amount paid was 280 million dinars on the 31st of October, when there were 4.9 dinars to the dollar. So this is going to be credit cash, $57 million, debit payables, $57 million. So can you see we've got an adjustment to make? Our purchase of PPE should not be $78 million as is shown in the additions, but our purchases of PPE actually comes from working number 7 and is $57 million is the cash which has been paid. It then says exchange gains and losses are included in admin expenses, so we need to work that out. At the year end, Yep. Because we've not paid all of the amount to the supplier, have we? So that's why it's not the full 76 or 78. At the year end, our payable outstanding is still 100 dinars, okay, 100 million dinars, and we're going to translate that using the closing rate of exchange of 4.8 to the dollar. That gives us a figure of 21. This is an increase of 2 million, because if you look at the difference here, we appeared to have a $19 million payable figure. But when we've restated it at the year end, we've restated it to $21 million. So it's an increase of $2 million. That's going to be debit the income statement 2 million, credit payables 2 million. That's gone to admin expenses. This is a non-cash expense. What do we do with non-cash expenses? We add them back to profit. So our exchange loss from working number 8 is 2 million, and that is added back to profit. What else have we got to do? Well, we've now got to recognise that payables have increased by a further 21. We've got this 21 million to adjust for. So I'm going to go to payables, and we now have a currency payable of a further 21 million to look at in terms of our overall movement. So that means that payables movement in total is 86. So that deals with note 3, which is a huge note. Note 4, Warrburt purchased 25% interest in an associate for cash. The net assets of the associate at the date of acquisition were 300 million. The associate made a profit after tax of 24 million. So if it made a profit after tax of 24 million, our profit share is going to be 25% of 24 million, which is 6 million. That's fine. And paid a dividend of 8 million. How much of that dividend will we receive? Our dividend received is going to be 8 million times our share of 25%, which is 2 million. We invest in associates, so therefore this represents investment income. We go to investing cash flows, associate dividend is 2 million. Note 5, an impairment test was carried out at the end of the year on goodwill and other intangibles. Goodwill was impaired by 20 million. So what do we do with that? Well, that gets charged to the income statement. So I'm going to say here, goodwill impairment 20 million. I'm going to add that back. And intangible impairment is 12 million. I'm going to add that back because both of those get charged to the income statement. I also need to reflect those in our T accounts. So we've got an impairment in the income statement for goodwill is 20. An impairment in the income statement for intangibles is 12. And do you see that those two accounts now balance themselves off? So we're not going to have to worry about any further adjustments. The short-term provisions relate to finance costs. We've already dealt with that. So therefore we've dealt with all the information in the question. What we now need to do is to tidy up our T accounts. If we go to our tax account, our balancing figure works out as 39. So this is cash. What do we do with tax? Well, unless you're Apple, you pay it. So I'm going to put that figure of 39 into my cash flow statement. Normally goes at the bottom of operating cash flows. Tax paid, working number 1, 39 going out of the business. In terms of associates, I've got 102 here. 102 must equal 102. What must we have done? It says in the question that we've purchased some shares in an associate, and we made that purchase for cash. So the balancing figure in my associates T account is 96. We invest in associates. We've invested 96 buying some shares. Associate purchase from working number 1 is 96, like so. So I've dealt with note 1, I've dealt with note 2, now I'm about to deal with note 2. 13 less 5 gives us 8. This must be cash interest paid, as opposed to the interest charged in the income statement. If it's interest paid, you actually have a choice. You can show this in either operating or financing cash flows. The choice is yours. I'm going to stick it in financing cash flows, and the reason why I'm going to show it in financing cash flows is that I'm running out of space in operating cash flows. So interest paid, how much was that? That was 8 from working number 2. So we've dealt with tax, we've dealt with goodwill, we've dealt with intangibles, we've dealt with our disposals, and we've dealt with currencies. We've now dealt with every single element of the cash flow statement. So what we've now got to do, our remaining activity, is to add it up. So financing cash flows, if you add those all up, comes to an outflow of cash of 11. If we take a look at our investing cash flows, (45 plus 57 minus 12), that gives us an overall cash outflow of 43. And if we come to operating cash flows, and it's a mammoth operation here, if we add all of these up, operating cash flows, we start off with a loss, we add all the adjustments through, and that gives us an operating cash flow total of 19. 19 minus 43 minus 11 adds up to minus 35, and our cash flow statement balances.